As of 10:30 a.m. Eastern Time on November 5th, McDonald's Corporation is trading at $307.72 per share, up a very strong $8.62 or 2.88% on the day. Now, the expectation here, the immediate story, is that this is a massive earnings day victory. The market is open, the stock is surging, and anyone checking their Fidelity mobile app or Robinhood app sees a sea of green. The narrative is that the Golden Arches just posted a flawless quarter. But the instant, hard reality that this $307.72 price hides is so much more complicated. That 2.88% pop is not a simple celebration. The company just missed Wall Street's profit expectations. This move isn't what you think it is. This is the market surgically ignoring a profit miss, desperately looking past the bad news and clinging to the sales numbers as proof that the giant is still fine. This $307.72 price reveals a profound tension in the market, a deep-seated battle between a very strained U.S. consumer and a brand that is trying to prove it's still a global growth story. For decades, the common ground for McDonald's has been safety. This is the stock you buy and forget about. It's the widow and orphan holding, the ultimate blue-chip dividend aristocrat. It's the definition of a core holding for a Fidelity Iris account or a Schwab Intelligent Portfolio strategy. This is not a speculative investment. This isn't Tesla stock or Nvidia stock, which you buy for a 10x return. This is the stock you buy for its stability, its predictability, and its massive moat. It's a core holding in countless Fidelity mutual funds and Fidelity ETFs for a reason. It's supposed to be a fortress. The expectation is that McDonald's is a simple, safe, and boring business. But the reality, as revealed by the Q3 earnings report that just dropped, is that this business is not simple right now. It is walking a razor's edge. Let's break down the numbers, because this is where the real story is. The reason the stock is up 2.88% is because global comparable sales, a key metric, rose 3.6%. This just beat analyst expectations of 3.59%. A tiny beat, but a beat nonetheless. U.S. comparable sales were up 2.4%, which also beat a very low expectation of 2.14%. And the international segment was strong, with licensed markets up 4.7%. The market is looking at this and saying, see, the accelerating the arches strategy, the focus on digital, delivery, and the drive-thru is working. The brand is resilient. Now for the reality that the bulls are ignoring. McDonald's reported adjusted earnings per share of $3.22. Wall Street was expecting $3.33. That is a miss. They fell short on the bottom line, on actual profit. Revenue came in at $7.08 billion, which was also a slight miss against the $7.09 billion estimate. So let's be very clear. The stock is surging 2.88% on a day when the company missed on profit and just barely met sales expectations. Why? Because the market is forgiving the profit miss, which included $39 million in restructuring charges, and is placing 100% of its faith in the sales numbers. This isn't a sign of universal strength, it's a sign of relief. It's the market breathing a sigh of relief that in this tough economy, sales didn't completely fall off a cliff. This brings us to the core, frightening tension for this company: the U.S. consumer. This is the part of the story that should worry anyone looking at this stock as a self-investing pillar. That 2.4% comp sales growth in the U.S., it was not driven by a flood of new customers. It was driven once again by positive check growth. That is a corporate buzzword. What it means is higher prices. McDonald's is getting more from each order, but it's not because people are buying more food. It's because the food they are buying is significantly more expensive. This is the central gamble. The expectation is that McDonald's is the value leader. The reality is that its value proposition is being stretched to the breaking point. The company has been aggressively raising prices to offset its own inflation, and it is testing the loyalty of its most important customer base. This is a high-stakes bet. They are shedding their low-income, price-sensitive customers who can no longer afford the menu, and they are hoping to make up for it by charging more to their remaining, more affluent customers. This is not the safe McDonald's of the past. This is a company taking a calculated risk, and the 2.4% comp number shows that, for now, it's barely working. But it creates a massive vulnerability. This isn't a stock that attracts a lot of short sellers. The short interest is tiny, around 1.03%. This isn't a stock you'll see in a high-stakes battle on interactive brokers' trading platforms. The war isn't with shorts. The war is with its own customers' wallets. This is where the long-term expectation collides with this short-term reality. The bull case for McDonald's, the one that Fidelity Wealth Management pitches for its clients, isn't about the next quarter. It's about the Accelerating the Arches 2.0 growth plan. This is the narrative that the $307.72 price is really based on. This is the plan to open thousands of new restaurants, pushing their global footprint to 50,000 stores by 2027. This is the plan to grow their loyalty program to $45 billion in annual system-wide sales. The bull expectation is that McDonald's is not a U.S. burger joint. It's a global tech and logistics company that happens to sell burgers. They see the international licensed markets, up 4.7, and see a blueprint for a decade of growth. They see this as a safer bet than the volatility of Apple stock or the cyclical nature of Nvidia stock's chip demand. But let's look at what the professionals truly think, beyond the initial 2.88% pop. If you look at the 28 analysts who cover McDonald's, the consensus rating is not a strong buy. It's a hold. This is a critical piece of investment help that many online investing sites might gloss over. 15 of those 28 analysts rate the stock a hold. Only 11 say buy, and 2 have an active sell rating on it. The average price target is $323.43. With the stock now at $307.72, that represents very little upside. This is the real disconnect. Retail investors, perhaps using a simple SoFi trading platform or SoFi active investing account, see a safe stock. The professionals at major investing sites and Fidelity Investments see a company that is already priced for perfection, with limited upside and a massive growing risk in its home market. They see a company that missed on profit and is now trading at a very rich valuation. This is not a stock for Robinhood fractional shares traders looking for a quick flip. This is a stock held by massive institutions. Fidelity, Vanguard, and BlackRock own hundreds of millions of shares. This is the bedrock of many intelligent portfolio allocations. But the question for a self-investing individual is what you're buying today. Are you buying the long-term expectation of 50,000 stores and digital dominance? Or are you paying a premium for the reality of a company that is squeezing its U.S. consumers with price hikes just to keep its sales numbers positive? The value menu is at the heart of this conflict. I want to know what you're seeing in your neighborhood. Comment below with the price of a Big Mac meal in your city. I want to see just how much the value menu has changed across the country. Looking forward, the future for McDonald's is binary. The bull case is that the U.S. consumer holds on. The price hikes stick, accelerating the arch's works, and the massive global expansion and digital loyalty program create a new, unassailable moat. In this scenario, the stock cruises past the $323 analyst target and continues to be a core, reliable compounder for any individual brokerage account. The bear case, the reality that the hold ratings point to, is that the U.S. consumer finally breaks. The price hikes go too far, traffic turns negative, and the value proposition is permanently lost to competitors and grocery stores. In this world, the company's profit miss this morning wasn't an anomaly. It was the first crack in the foundation. The strong international growth will no longer be enough to offset a decaying home market. So, in conclusion, that $307.72 and that 2.88% pop are not the simple, happy earnings story you think they are. The expectation is that McDonald's is a fortress. The